This is TreppWire Week in Review for week ending August 6th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS Commercial Real Estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Darren King, Head of CMBS. This week, air travel drops after hitting a post-pandemic peak while the U.S. meets the milestone of a 70% adult vaccination rate. And the CDC issued a new targeted eviction moratorium. In economic news, a lot of new data as travel-related earnings highlight a rebound, but separate jobs reports seemed contradictory. The ADP private jobs number was dismal, but initial and continuing jobless claims showed continued improvement. And economic activity in the services sector grew, setting a new record last month. Manus, the debate over the Fed's monetary policy was back in the forefront as Fed Vice Chair Clarita said that the bank could hit its economic targets by the end of next year.
It certainly created a lot of headlines, that's to be sure. But I think the takeaway from this week is just how complacent the market appears to be right now. When you think about the litany of negative headlines that we saw this week and the really muted reaction we saw from investors, I think is the story. You mentioned the terrible ADP number. It was about 50% of what expectations had been, less than 50% of the June number, right? Which is telling us that this economic recovery is limping along. It's not this 10 weeks of Mardi Gras that some were anticipating a few months ago, a term that we've picked up before. You also mentioned the hints from the Fed chair that interest rates might be hiked sooner rather than later. Sooner is a relative term. He's still talking late 2022, but that's earlier than some market watchers are thinking. In that ISM report that was a new record high, there were more hints that costs are soaring, right? More hints of inflation are out there, and a growing number of businesses delaying their return to the office. So all of that was met with a collective shrug by investors this week. A couple months ago, when you saw hints of inflation, we saw sell-offs. When last year we saw any kind of new variants being talked about, there were sell-offs. Now, I don't know if it's the dog days of August, people at the beach and the mountains, and nobody's really focused on the markets right now, or if it's just that the earnings season has been so doggone good that it's just overwhelming any negativity we see. But the truth of the matter is all of this was just caught up in the wash this week, and investors just really didn't take any of this to heart.
Yeah, the 10-year note, as we look at equities, continuing to rise, you had the 10-year note going as low as 112, clearly not fearing any kind of imminent rate hike. I think at the point right now, it's taken some of that back to, 122. But you've got a bond market certainly not heeding any of the Fed's guidance or statements, and certainly not on par with what the equity market is thinking, which, it's been a long time for that. We haven't, it's not something new to these markets. Rates continue to stay down here regardless of fluctuations in the equity market, no matter how much it rises. So at some point, someone's got to be wrong, you'd think. But thus far, I think both sides have proven ways to make money being long both fixed income, in a rally and the equity markets in a rally.
I talked about the things this week that made the headlines that may have in other times moved the needle, but there are other things looming out there that also have the potential to move the needle that investors are also just really not handicapping at all at this point, right? We're talking about probably 5 levels of tax hikes that in some way, shape, or form will hit us over the next 6 months, right? A personal income tax, a business tax, maybe some kind of estate tax, a capital gains increase, perhaps a gas tax, which has been talked about as well. And, none of that seems to come into the calculus either, that we're still on the equity side paying huge multiples on earnings right now, near historic highs. And, on the rebound, the economic rebound side, I still think that the smart money or all the money is on the side of risk on at this point. And to your point, Darren, somebody will be wrong in this whole thing. And at some point over the next 6 to 12 months, we'll find out whom.
Yeah, I think, when you look at sort of whether it be taxes or just the political climate, we also inch day after day closer to, 2022 midterms, and you take an already dysfunctional Washington and probably make it that much more dysfunctional as everyone turns toward, do I need to get reelected, or who do I want to get reelected? Who in my constituency and my party needs help in their primary, and then in their general to hold their seat? That even more behavior shifts toward keeping my chair as opposed to even pushing an agenda.
I was on a good conversation this week with an MBA panel. They've been working on several of these all summer long. And this particular one talked about tax implications. And I would say, the real expectation is that there's no way around this. And the best we could hope for at this point is that commercial real estate is not disproportionately harmed by more regulation or more tax than any other kind of alternative investment, right? That's the hope, that when you add it all together, right, the capital gains tax, maybe a 1031 alteration, right, general corporate taxes and so forth, that the totality of it doesn't make it any more disruptive to the CRE market than it is to other types of investments that money managers look towards.
Yeah, I think the piece I'll add to that, as far as where commercial real estate stands, the sector kind of has a little bit of the wind at its back from an inflation perspective, because it's an asset class that's inflation protected, right? You get to raise rents, some asset classes quicker than others, hotels and multifamily in short order, but even in office industrial retail, right? Rent bumps are built in. You have the ability to move that cash flow. So if there isn't an overly harmful impact to real estate versus other asset classes in terms of taxes, it's actually a sector that's really got an opportunity set to really outperform, assuming that the Fed may be a little bit offsides, and that inflation is a little bit more than transitory.
Many were watching travel earnings this week to gauge the strength of the rebound and any signs of trouble on the horizon. What did we see?
Great week, actually, for commercial real estate, in my opinion, in general. And we're going to talk both about hotel and retail, the two hardest hit segments of the market during the pandemic. But when you look at the earnings we've seen come out in the last couple of weeks, they've been generally better than anticipated, right? I think that people were expecting a nice recovery of the hotel industry. Some of that was already baked in to the earnings expectations, but several firms this week saw their shares bump up nicely as they beat both on the top line and the bottom line. And that was terrific to see. As a parenthetical to that, apart from earnings, in our delinquency report this week that we released earlier today, the delinquency rate on hotels dropped another 2 percentage points between June and July, and is now 50% of what it had been at its worst moments last summer at the height of the pandemic. So between the earnings we saw this week from some very big names and the drop in delinquencies, and in a moment I'll get into some transactions we've seen as well, it was a very nice week for people that may have been, well, certainly for hotel owners, but for those that were still skeptical about the hotel market, I think they can be less skeptical now.
I'm filling in for Joe this week, and I just imagine him on vacation, going floor by floor, counting occupancy in the hotel, then at the breakfast buffet line, grabbing a cheese Danish, polling everybody. So you here on business or leisure?
That is definitely Joe.
Yeah, it's funny. Joe, he has told me before, he's a beach guy this week with his family, and he was checking in, asking via text how things were going. And it reminded me of a story he told me, which I don't think ever made it to the podcast, but it was one that just stuck in my memory, was that when he was a teenager, his big thing used to be to sneak under the boardwalk and stick those dollar bills through the cracks and try to get the old people to stop and try to pick up the dollar bill and snatch it away from them just at the last second. And he said one of his really embarrassing moments was he tried it with a 5 once, and the guy was too quick for him. And the guy actually lifted a 5 from him. And it was something, it was kind of like my 3-card Monty loss when I was 14 in New York City. It was just a lifetime of embarrassment from that one silly decision.
That's justice, I think, actually. So, you talked about hotel earnings. A lot of the calls were colored by discussion regarding leisure travel, business travel, and how business travel has been coming back slowly, but coming back all the same. And one of the tailwinds that might turn into a headwind is changes in policy, right? So some of the conventions are now going back from in-person to either canceling altogether to next year or coming up with a different plan. And I think we saw that this week with the New York Auto Show.
Yeah, that was quite a disappointment. We have said for more than a year that our expectation would be that business travel would lag leisure travel. And that has clearly been the case. Even last week, we talked about how markets like Orlando and San Diego and others, in terms of their midweek bookings, were outpacing places like New York and Chicago. And I think we were all counting on getting past Labor Day and starting to see these conferences start, people going back to the office, business travel commencing again. And now you have kind of a double whammy. We've seen, 5 or 10 really big, bold-faced names in the equity markets say they're going to push back their start date from Labor Day to something maybe October or November. And now the cancellation of the auto show, not a great thing for an industry that was hit hard and we knew was going to be slow to recover.
The one piece of that I'll add that continues again to be a headwind is international travel, which was already so far reduced. The most recent proposal from Biden was essentially anyone visiting would have to be vaccinated in order just to get in the country, right? I think that was the latest statement. And other nations haven't hit our vaccination levels, including a lot of the Western European countries that we rely on for tourists in places like New York. We're already at a depressed state of that, and if you take out even more folks who can't enter the country to participate, whether it be business or leisure or for events, when do we hit rock bottom? When is it just literally throwing in the keys even further that we just can't sustain? Hotels in New York City just can't sustain, or San Francisco can't hang on to this anymore.
Before I get to several hotel transactions that I want to cover, let me ask this of Martha and Darren. Are you going to miss the car show? You guys car guys?
Car gals.
Gals?
Car
people?
I would definitely go to sit in kind of a gee whiz cool. I have been known to drive a muscle car in my history and owned one, actually, a nice V8 engine.
Wow.
And yeah, so it is disappointing. And I know Chicago had their auto show. I heard it was scaled down and they had a lot of it outside. And I don't think they had the same challenges that New York has regarding some of the restrictions. But yeah, it's a shame that it's not happening.
And how about you, Darren? A Taurus or a Maserati?
I haven't owned a car since 2001.
Wow.
I've been a New York City guy my whole adult life. There just hasn't been a need. I'm not sure I can barely drive at all anymore.
Yikes.
So let me run down a couple of hotel transactions. I said earlier, this was a great week for certain parts of the CRE market. And I'm going to highlight a couple of things that I was really glad to see in terms of the rebound of transactions taking place. The first one I'll highlight, the first three are kind of yawns because they're in markets that are strong, not so heavily hit by COVID. Transactions continue to take place, but there's still positive signs nonetheless, and they give you some benchmarks for where you may want to mark your hotel assets if you're in these markets. So the Atlanta W Hotel in Midtown, that went for $160 million. Turns out that that's $370,000 per room. That story comes from the Atlanta Business Journal. As I said, Atlanta not terribly hard hit with distress in the hotel market, but for those in that market, a full service hotel now getting $370,000 per room. Two in the Miami area, the Salino South Beach at 640 Ocean Drive was purchased by an A-Rod backed fund. That story comes from Hospitality Net. It's a 132 room hotel. Also in Miami Beach, the AC Hotel by Marriott, that's a 145 room hotel at 2912 Collins Avenue. Again, Miami Beach has really done well relative to other parts of the market. Now I'm going to talk about two which are in markets that have been just really punished over the last year that saw transactions take place. The first one, this comes from Real Estate Business Online. In Chicago, the 247-room Thompson Chicago Hotel went for $70 million. That's about $285,000 per room. So if you're in Chicago, if you're looking at distressed assets, this is a benchmark for you to see either, what you might be able to purchase if you're looking to buy some of these plentiful distressed assets in the Windy City, or if you're an owner to kind of get a sense of what your property might be worth. Even more impressive in Houston, the Hotel Alessandra, fully shuttered hotel, not even operating, went for $65 million to host hotel and resorts. That turns out to be $291,000 per room. I think Houston had more hotel operators turning back the keys in 2020 than any other market. So definite green shoots in two markets that were really pounded in 2020.
So turning to retail, Simon Property Group saw its sales bounce back to pre-pandemic levels in the latest fiscal quarter. But what were some of the key takeaways?
So yeah, Simon really knocked it out of the park. We talk about obviously a mall REIT, and I guess now they're a retailer, given how many different fashion brands and the like that they own, going from JCPenney's through Brooks Brothers. But they really, as Martha said, bounced back substantially. Their sales numbers for June were comparable to their sales numbers from June of 2019 and up 80% from this time last year in the midst of the pandemic. Their funds from operations, 1.2 billion or $3.24 a share, up over 50% from the prior year. Some other really great signs within it. They signed 2,500 leases for over 9.5 million square feet in the first half, 3 million square feet more than they did in the first half of 2019. So, phenomenal numbers, phenomenal performance. I think one of the key things to look at as sort of a comparative benchmark for them versus maybe some other mall REITs out there is their average base minimum rent is $50 a square foot, 55 if you kind of include the realized variable rents. So look at that how you will, but somewhere between $50 and $55 a square foot. That clearly is on the higher end for mall operators because frankly, their assets are on the higher end. So as you kind of think about Simon versus any other of the mall REITs out there, recognizing, that $50 number doesn't necessarily compare or does compare favorably to, what you'd see from a Macerich or the old CBL or a Pennsylvania REIT kind of number. The other interesting parts of that and takeaways, David Simon is always a good guest to have in anything, even on his own earnings call, referring several times to some of the retail ventures that they've purchased as dead and buried or roadkill prior to Simon and Authentic Brands and Brookfield's acquisition of the various entities. And still certainly in finance parlance talking his own book, but pointing out that the physical presence of these assets is still what makes them go. Simon has the capital with which to create that omni-channel and online presence that maybe they didn't before they were acquired. But owning to the fact that having that physical location within obviously the Simon malls and as well as other operators' malls is still the key to their success. The one final piece of this, which I just thought was a little eye-raising, and it relates back to CMBS, is he was asked by an analyst about the mortgage financing environment and made a comment related to the Domain, which was a very recently financed mall in CMBS, $210 million asset, that they, quote, overfinanced it. It's not a term I've heard before. Just to point out, and for any of our listeners who may own it, the servicer issuance data for that pegs the loan at a 46 LTV, a 14% debt yield, 4 times debt service coverage. So this doesn't appear to be an over-levered loan, but I'm not sure what he means by overfinanced. Doesn't sound good if you're a debt owner.
We need to get to the bottom of that. Overfinanced sounds like over-managing in baseball when things are going along swimmingly and then the manager walks out and changes the pitcher for no reason, and all of a sudden, a 4-0 lead becomes a 6-4 deficit. When I hear something like overfinanced, it makes me think that something was made more complicated than it had to be. So I'll be interested to find out, if we can, from Simon or somebody else what the term actually referred to.
Yeah, I mean, just based on our data, there's no secondary debt, no mezz or anything on this. It actually looked like a solid loan. The Austin, Texas, million square foot mall with, I think close to $600 a square foot in sales. Looks like a good asset for sure. Just, maybe occasionally at times it might be good to keep your mouth shut.
I should heed that advice. It expands beyond just the podcast into just my broader life in general. So I'm going to write that down while I have a minute. I'll point out two other things I saw in earnings this week that caught my attention. You mentioned, Darren, that Simon is, really upscale, Class A mall, kind of the higher end. There were also earnings from Macerich, which occupies a different part of the mall spectrum, more of kind of the A-B, C caliber mall. They seem to be hit harder during the pandemic than the Class A's were. Nonetheless, they too posted great numbers. The firm saw funds from operations, FFO, at 57 cents. That compared with analyst expectations of 44 cents a share. Revenue, 215 million. That was up almost 50 million from 2020's second quarter. Of course, we had a big rebound, so that was to some extent expected, but it was still 30 million over what consensus estimates were calling for. In addition, they said occupancy jumped by almost a full percentage point over the last 3 months. So this rebound that we're seeing, not just limited to the Class A, which is nice to see. The B's and the C's have really been pounded, a word I seem to be using a lot over the last year. Another one we saw, which was nice, although it had a footnote to it that was a little bit worrisome. Tanger Factory Outlet Centers announced that foot traffic at their destinations had been higher during the last quarter than they had been during a comparable time in 2019, which is another part of the market, right? We talked about the A part of the market, the B and C outlet centers in a completely different part of the market. So they too seeing more foot traffic than they were seeing before the pandemic. Another incredibly great green shoot. The one concern that they put out there in their remarks was that only about 50% of the leases that are set to expire this year have been renewed at this point. So that's something that we're going to have to watch over the remainder of the year in the first half of 2022. But from Simon to Macerich to Tanger, just a lot of good news out there.
And another piece of news unrelated to earnings, Foot Locker filed a lawsuit. What's going on there?
That's an interesting one. Basically, they are in the Palisades Mall. I think they have two different stores in the Palisades Mall. That's the mall that if you're in New York and you go over the Tappan Zee Bridge on your way to upstate New York along 87, it's a real eyesore, but it is a big mall. It's one of the biggest malls in the country. Over the last 4 or 5 years, it's lost a lot of tenants. It's lost JCPenney, it's lost Lord & Taylor. And the contract with Foot Locker and the owners of the mall were such that if they lost a certain number of anchors and were left with X number of anchors with more than 50,000 square feet, their rent became a fraction of sales. And that kicked in at one point, and that's what they were getting billed for a certain period of time. But the owners of the malls came out and said, well, we've now backfilled some of these spots with Dick's and others that you should go back to paying full rent. Foot Locker came back and said, no, we shouldn't because these parcels are less than 50,000 square feet. So they took the owners of the property to court because they were afraid that the owners of the Palisades Mall were going to cut them off and actually kick them out of the mall. And the Foot Locker wants to keep a presence at the place. They want to pay the percentage of rent and they don't want to be kicked out. And on the other side of it, the mall owners are trying to squeeze them to either pay the full boat or to get rid of them. So that's a little inside baseball for those that are either retail operators or mall owners, something that, and I think we'll see more of this, as time goes on, that there'll be more of this litigated as people try to get to the bottom of what exactly is fair and what does the contract say.
Yeah, talk about your Twilight Zone, right? a mall landlord suing to get rid of a tenant, and the tenant actually, countersuing or involved in a lawsuit to actually keep their lease. I don't think we see that too often.
I'll go back to the car thing. So Darren, are you a sneaker guy or a loafer guy?
A running shoe guy.
You're a running shoe guy.
Can't say I do too much. Yeah. Can't say I do too much, in terms of the, buying the Steph Currys or whoever else's, brand is hot.
So turning to office, LinkedIn has reversed course and says that most employees can now work from home forever.
Join the long list, right? We've seen a lot of this going on. Either don't come back after Labor Day or don't come back at all. They did put that parenthetical in there, which is if you're not going to work in San Francisco or New York, don't expect to make San Francisco or New York salaries, right? That always seems to be part of the contract. We did mention in our TreppWire this week that LinkedIn does have a very big presence. In fact, they're the sole tenant at a big San Francisco office. Their lease goes for a considerable period of time. It's got several years to run. So when things like this come up, we do mention to our readers and our clients, this is when you want a footnote, right? As you get into that 2023, 2024 time when the loan is getting closer to maturing, you want to know that is this a problem waiting to happen, or is this something which is going to be easily refilled should LinkedIn not pivot to something new?
Yeah, I still look, I may be on the other side of this. I think it's permanent until it's not anymore. I still see a lot of this as potentially just reactionary to the time we're in. Some firms were always going to come back in full and hybrid, a handful saying, fine, work remotely forever. You start to hear less of that as, vaccinations got rolled out and people felt safer. Delta spikes numbers in places, and all of a sudden you're hearing the reaction again. And I think tech companies more than others are going to throw things out there to be attractive to their employees and be attractive, frankly, to potential new employees, which, are, as we've seen, very difficult to hire in this market. So it would not shock me that permanent lasts for a year and then it's slowly bring people back in, or your new hires are part in office. And this is a negotiating point of these things. I will ask the question sort of tongue in cheek, and right, all these Salesforce, LinkedIn, they all put their names on the side of these buildings. What happens then? What do you do with that, with their branding once they go away, if they go away?
Well, the funny thing was years ago, the best thing that you could short was firms that had put their name on the side of a football stadium, right? For a long time, that was the kiss of death, for .com companies that had put their name on the side of football or baseball stadiums. Whether this becomes true of offices as well, I don't know, but offices have been named for a long time. So I think that's a trend that will endure, unlike the .com stadium naming fad or the .com boom in general. Turning to the other side of the coin, we talked about people not coming back to the office in LinkedIn or delaying their return. We listened to the Vornado earnings this week, and just as Boston Properties were, their executives were really, really bullish 2 weeks ago, Vornado was just incredibly bullish as well. They talked about just incredible demand from the likes of Apple and Google and Facebook for their space. For those that are not in New York, the firm has been a huge acquirer of space around the Penn Station, Madison Square Garden corridor. And they put Facebook in there a year or two ago with a big lease. And they were really gushing about how much demand there is from tech companies for that particular corridor. And that's also near Hudson Yards and Chelsea area, which has been very popular for FANG names as well. But it goes to the point that Darren made a few moments ago, which is it's a trend until it's not a trend anymore. And if you're listening to Vornado, they're telling us the trend is going to be really short-lived, that these firms are coming back. It may be a blip after Labor Day, but they are expecting to be, hiring thousands of tech workers month after month after month going forward.
Yeah, I think this also is a sign of certainly their confidence and the continuing trend toward moving to Class A assets. right? It's when you think about New York City and San Francisco and other gateway markets, it's the Class B and Class C. It's the building that has 2 elevators versus having 4 elevator banks. It's all the ability to upgrade and do all the things we're going to want from a health and safety standpoint, and the amenities and outdoor spaces and things like that. Vornado can do all of that, right? They have the capital and the quality of the assets that they acquire and own provide that. So I think they're making their bet, probably rightfully so, on the fact that not only is there going to be great demand, but it's going to be demand for their kind of Class A space.
The big tell for me for what was B and C back in the day was, did they still have that mail slot? When you got off the elevator, was there that mail slot right next to the elevator where you were expected, or you could, throw in your letter rather than go to the post office or walk to a mailbox or so forth? And you still do see them in some Class B buildings from time to time.
My apartment building has that mail slot.
Does it still operate, or have they taped it over?
It absolutely operates. I'm sometimes hesitant to use it, and I'm not sure how often they look in there, where I'll just go to a mailbox if I actually need it occasionally. But yeah, still got it.
About 15 years ago, there was a story, maybe longer, that somewhere in the Rock Center area, they had told people to stop using it, but they didn't tape them over. So people kept using them, but they never stopped. They stopped checking. And by the time they figured out that this was a problem was years later, and the mail had backed up to the 3rd floor, and they actually had to take out a wall to remove all the mail that had been sitting there in this slot for a decade and a half. So
the checks in the mail
in your
wasn't
case,
a lie.
Darren, I hope that they're not foreclosing on your your condo, because you're not going to get evicted. We know that, right? If the check's not in the mail, but
Check's in the mail. It's on the 3rd floor. So deal of the week takes us to Houston this week.
Yes, 2 Houston mentions. So Houston, we stated a couple minutes ago, kind of ground zero in the misery index when it came to hotels. Lots of defaults, lots of givebacks, lots of revaluations, negative equity, the whole thing. Also part of that market has been a really, really heavily hit office market. Tons of sublet space. There have been some very big losses among trophy assets in Houston over the last 5 years. So any lease in Houston, in my estimation, is a good lease. And in this case, it garnered the deal of the week. Aspen Technology, they're a Boston-based software operator. They signed on for almost 80,000 square feet. It's a lease renewal at 2500 City West Boulevard in Houston. Win Haggerty Jr. and Vince Strake of C&W and Dennis Taro of the Petrinelli Group, which owns the property, worked together to get this deal over the finish line. So as I said, this is not a CMBS asset, but any lease or any lease renewal in Houston is a good one, and this one is of decent size. So congratulations to all those that got that over the finish line.
And the must know of the week.
I have 2 must knows of the week. The first one, Project Falcon, which is code name for something that economic development agencies in Texas are working on to lure Wells Fargo for a new headquarters. This was reported on by several different publications last week. Right now, Wells Fargo is looking primarily at Las Colinas. The size of the parcel they're looking for would be about 400,000 square feet. There is a CMBS loan that has some Wells Fargo space. It seems to be a servicing operation of about 100,000 square feet. We'll write about that in TreppWire probably on Friday morning or Monday morning. But otherwise, this looks to be all new space. Wells seems to be focused on the urban center of Las Colinas, near the Irving Convention Center. It's unclear if this is a new development they're trying to take on, like JP Morgan did a couple of years ago, or whether they'll be taking on existing space. But if you're somebody in that area that has either space or land, and you hadn't seen this story out there, the eagle has landed, to use the cliche. Project Falcon is out there, and you may want to get on that because there's a big lease or a big development to be had One other that I thought was kind of interesting as well, this came from the Triangle Business Journal. Comerica Bank is looking to really build up its Southeast strategy. They're looking to establish big offices in Raleigh, Winston-Salem, and Charlotte, and they're starting by looking for new space in Raleigh. It's unclear how much space they're looking for, but it is something that they plan to go really all in. They really want to grow that presence. They're a bigger presence in the Southwest and a little bit to some degree in the upper Midwest, but they want to attack that North Carolina, South Carolina, Georgia market. So if you're in that Winston-Salem Triangle area or Charlotte, a call to Comerica might be on your to-do list.
Turning to multifamily, the CDC extended an eviction ban until October 3rd. And I know we talked about this last week because it expired last Saturday. And it looks like they're hoping that the long delayed rental assistance gets in the hands of those that haven't been able to get it. And interestingly, a side note, the National Apartment Association sued the federal government for $26 billion in monetary damages due to the ban. So this continues to play out.
Is there a more distinct piece of dysfunction than what we've seen with the eviction ban over the last 3 months, right? Joe was joking around, last week about DMV, but this is a little bit like DMV on steroids. When you think about how many things have gone wrong, right? And I'm going to run down the litany and I'll let Darren kind of talk about the economic implications after that. But the Biden White House waits till the absolute last minute to tell Congress to do something, right? Congress is on the precipice of leaving for vacation. They already know that the Supreme Court has ruled this unconstitutional. They have other methods for addressing this problem to the tune of $50 billion, which is out there for rent relief, yet they've only gotten out $3 billion of it. And I believe not a single dollar in New York, right? If you think about that. And we're extending it again without any real income testing, means testing, right? If you talk about something which has been so mismanaged right from the start, this is it. And I'm not really talking about the human side of it, right? We need a safety net in this country, and we need the ability for those that, kind of hitting the rocks economically to have, some kind of safety net. But if you're going to have a safety net, have it work. And this has just been one mistake after another, after another, after another. And I do think that it's one of the reasons that people just kind of throw up their hands when they look at what's happening in Washington and try and wonder why things can't get done efficiently ever.
Yeah, this thing suffered from practicality problems like from the moment it started, right? Like you said, it was a good idea from a safety net for people. Even some of the merits of it from actually delivering the money to the landlord to cover the back rent owed by the tenant, and therefore then you kind of give the tenant a chance to stay in, right? That had the right metrics to it. You weren't just handing money to a tenant who may or may not put it in their pocket. You obviously have to worry that the landlord won't then go and evict once they get the money, but you were then in there supporting, the person who is owed the money, except, from the federal government on down to the local bureaucracies that have to then dole it out. Like you pointed to, Manis, only $3 billion has gotten out the door, and there's a stack of applications on the desks of these local bureaucrats to do it. And then, I saw a survey the other day that something like half of landlords didn't know it existed, right? How are you going to use something that's literally sitting there, $46 billion, and half of landlords in this country don't know it's there? And this is an issue that's affecting not Class A in Manhattan or San Francisco, again, gateway cities. This is Class B, Class C workforce housing type of people who are making under $50,000 a year, or were making under $50,000 a year before they may or may not have lost their jobs. They're the ones who need it, and their rents, to those landlords are often, not the public REITs and things like that. Some of them certainly are, but it's a lot of more local landlords, mom and pops who own 10 or 15 units, things like that. You're literally in a place where the two people who need it most, and it's there waiting for them, can't get their hands on it.
I just have this image now. It's just coming to me now. We talked before about the mail slot and mail piling up 3 floors long. I have this image now of Washington. Like, we've passed so many of these bills, and you hear reports of money not getting out the door to any of these programs for which it's been targeted. And I picture it to be like the mail slot. We're just funneling more money in, and it's just never coming out the other end. It's just piling up and piling up and piling up. It's a shame, because if this thing had been tailored correctly, it could have helped the landlord, it could have helped the tenant, it could have been done cost effectively, and it could have been humane. And instead, it's none of those things.
Yeah, and we just leave ourselves trying to, use the CDC as a way to just extend this eviction moratorium. And I think the part of it that really bothers me the most is you're going to wind up with evictions at the end of all this. There's going to be a date where you can just no longer do it anymore. So you're going to be putting people in difficult situations out on the street. Not a good solution. And landlords still aren't going to get the rent that they were owed. And yet the money is still sitting there. I think about it from the perspective of, if you could actually get this money into the hands of landlords, they have a much easier decision, much better decision to be made, which is, if I can get my back rent, if I'm owed 3 months back rent, and I can actually get it from this program, and my tenant in an economy that's improving, in a job market that's improving, actually can land a job to continue to pay it, I am better off as a landlord in that situation than evicting the tenant, getting a new tenant, because if it's 3 months back rent, the average monthly rent has to be up by 125%, or it has to be 125% of the old rent in order for me to make up the difference of the bad debt loss that I've got. So this is a solution for all sides, if we could just, get the checks written.
Right. For people at the lower end of the economic spectrum, there is the potential for a quadruple whammy, right, coming down the road. And that quadruple whammy looks like this, right? Unemployment benefits, and at the same time, the eviction ban ends, at the same time that more restrictions come in economically, which re-shut down restaurants and other things, at a time where we're having relief fatigue, right? That people say, we're not spending another $1 trillion to pass more stimulus checks and stuff like that. And this was really avoidable. A lot of this stuff, had it been thought out better, and instead we took the fire hose method with not a lot of details and not a lot of oversight. And, there's this potential in 6 months that, people at the lower end of the spectrum are really back to square one. Hate to see that.
So last week we gave a sneak peek of our secondary metro area markets that are the top for commercial real estate investment, and we've released that this week. So Darren, take us beyond a sneak peek, if you would.
Sure. So secondary MSAs, we define by employment, in that market, somewhere between 1 and 2 million, give or take a little. So those kind of define the overall set of secondary market MSAs. So teased last week was that Austin, which had been in the top spot, fell all the way down to 5th. I also kind of wonder about Austin when it gets to bump up to primary MSA, given the the influx of employment in that market. But that's a conversation for a different day. Taking in the top spot this year was San Jose, which includes Sunnyvale, Santa Clara, kind of a bit of a tech hub itself. San Jose managed to take the top spot despite actually performing pretty poorly in one of our categories, which is the population growth rate. It's one of the cities, one of the areas that actually saw migration away from it. But the other characteristics, the performance of the loans, the amount of collateral, delinquency rate, all those things just performed so well that it made up for any population migration issues. Now, moving into the second spot, up from number 6, was Vegas, continuing a good trend in terms of that city, both in terms of performance of its office market throughout property types, has actually held up pretty well. Rolling out the top 5, you have Sacramento, Charlotte, and Austin, which we mentioned, and then so I'll toss in number 6 being Nashville, Tennessee.
Shoutouts. We had some newcomers in our list. John D. who commented on both episode 90 and 91 and loved the discussion on the office shakeout. Lucius actually guessed wrong on our trivia t-shirt challenge, but he did taunt you to go into some deeper tracks next time. So, maybe you should get it right before he goads you into making the question harder. I don't know.
We should send Lucius a consolation prize, maybe one of those, really used t-shirts that Darren runs in. He shouldn't walk away empty-handed, but if you get the wrong answer, you can't get
I like that.
a brand stinking new crisp blue Trepp Pod t-shirt. No, that's not allowed.
I like
Maybe
that.
I can go for a run in the Trepp Pod t-shirt, and then we can give it to
And
him.
then you can
There
do
you
that.
go.
He did ask also for more grammar lessons, so I think we're in trouble there. Susie sent us a boots on the ground view of the Destiny Mall, which I think was actually very valuable. She was actually up there for her 12-year-old's baseball tournament and walked through the Destiny Mall, noted that every fifth or sixth storefront seemed empty, foot traffic was light, and the busiest place seemed to be the Dave & Buster's, and she actually took photos to share with us.
Yeah, those AAU tournaments, those basketball things, I don't miss those. A lot of greasy food, a lot of sweaty gyms, a lot of bad officiating. One of the lowlights for me was going to one of these team dinners after 4 hours of bad officiating and sweaty gyms, and watching a guy who recently had like a triple bypass try to body the bloomin' onion.
Oh my.
That was like, just too much. That was time to call for the check.
That's a visual.
Yeah.
And we did have a number of winners to the question. And if I recall, Manus, you quoted, I went from Phoenix, Arizona, all the way to Tacoma, Philadelphia, Atlanta, LA was the quote. And that was Rockin' Me by Steve Miller. And a number of you got it right. Tom O, Matt O, Amar M, Brent E, Chris W. And they get a lousy Trepp podcast t-shirt. Congratulations. And thank you for submitting your answers. BB Dogged Tenacity said they were a little worried that Manus wasn't more bullish on the Delta variant brown shoots. So I don't know, Manus, maybe need to work on that a little bit.
Should we give another trivia question this week?
Give him another shot.
This is just for Lucius. You can't dance and stay uptight. If you come up with that one, we'll send you a t-shirt. We're going by the honor system. You can't Google that.
Yeah, exactly.
You got to sit down, have a glass of wine, hum it out. It's not something for anybody under 40, but it is one of my favorite songs when it comes up on the treadmill.
All right. So we'll keep that one as a take two. And with that, we'll close. Joe, I hope you enjoyed your vacation, and thanks to our producer, Haley Keene. Join us next week as we review what's happened during the week and how it may be impacting you. If you have a question or a comment or an answer to one of our trivia questions, send an email to podcast@trepp.com and visit trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.